We are back in the black hole of real estate, and I got an investor question this week regarding 1031 exchange. I thought we'd talk about that today and go a little bit deeper into why some people choose that and why it might make sense for you. This is your host, Ron Wojciechowski, for the black hole of real estate. All right, so 1031 exchange. This is also known as a like-kind exchange. So a 1031 exchange, what this means is you're going to sell a property and you're not going to have to pay the tax. You're going to be able to avoid the tax and put it into the future by investing in a new property with certain criteria attached to the process of doing that. So in a normal transaction, if you're just selling a property, and under current tax laws, and I'm not an attorney, let's just start right there, I'm not an attorney, but if you were to sell a property, let's say you bought it in 2025 and you sold it in 2025, so round trip, and let's say you made $30,000. Maybe you renovated or flipped or did something with it, but you made $30,000. That $30,000 is taxable income, just like your W-2 income, just like your 1099 income, and it's all in this year. So if you happen to be in a higher tax bracket, let's say 30%, then 30% of that 30,000 gain, if that's your true profit after all the expenses are out, then you're going to have about 9,000 in tax. Now, there could be, and that could have been because you paid 100 for it, you sold it for 200, but you had 70,000 in costs, and there's 30,000 profit left over. So it's the profit, and your CPA is going to figure that out for you. I'm not going to figure that out for you, but it's whatever your profit is. That's what's taxable. And so if it was bought in 25, sold in 25, you're at 30% tax bracket, you made $30,000, hey, you owe 9,000 to IRS, and that's it. Now let's suppose that the very same example, you bought it in 2025, you did all the renovation, all the same numbers, but you closed it more than 1 year into the future. Now, not just 25 to 26, because you can't buy it, can't buy it December of 2025 and sell it in January of 2026. It's got to be 1 year and a day. So it's what you're looking at next is long-term capital gains tax. So what the short term is if you made it in the same year. The long term is a year and a day. Now currently that's 15%. So on the same example, if you made $30,000 and you own the property for 1 year and 1 day or longer, then it's 15% tax. And if you look at that $30,000 profit, 15% tax, now you're at $4,500 tax. So the tax is cut in half if you hold it for a year. The beauty of the tax law. Now, by the time I'm done doing this, I'll probably change the tax law, but that's what it's been looking like for many, many years, and that's what I expect it and anticipate to continue. Now, let's suppose that you don't want to pay any tax right now. Now it begins to behave, and I'm going to use the example of a 401k. I think people are very familiar with the 401k. You have your salary, and if some money is taken out for the 401k, it's not taxable. It's tax deferred. So if you had a $5,000 paycheck and $500 comes out, goes in your 401k, 5,000 minus 500 is, you have $5,500 left, right? Or 45. Look at me and my math. Don't hire me as your CPA. 5,000 paycheck, 10%, $500 goes in your 401k. So there's $4,500 left over. That's what's taxable. So in the same example, if you're using a tax-deferred exchange, a 1031 exchange, a like-kind exchange, it's all about the same thing. You're going to pay the tax in the future. Because in your 401k, all the deferred money, when you retire, you start paying. When you start taking out, that's when you pay your taxes. It allows the money to grow more over time because there's more money to be doing the growing with. So in the very same example, you bought the property and you profited $30,000 when you sold it. That money cannot go in your hands. At closing, it goes into your 1031 exchange intermediary. They're going to keep the money. You can't touch it. Same as a 401k. You cannot touch it. It stays in there in their escrow holding account to be used for a future purchase. And I'm going to explain that in a moment. So you're going to keep all $30,000. And somewhere down the road when you're done doing 1031 exchange, maybe at retirement, just like your 401k, Then you start to draw some of that money out of there or sell things off and pay the tax down the road. Now, you're going to have to identify 2 properties within 45 days of your closing. So you have your closing. You sell your property. You want to do a 1031 exchange. Great. Now, within the next 45 days, you've got to identify 2 properties. And you must close on one of them within 180 days, so about 6 months. And if you do that, then it's complete. Now, if you do the 1031 exchange and you fail to identify 2 properties within 45 days, regular sale, you owe tax, whatever the situation is, short or long term. Let's suppose that you complete the sale, you identify 2 properties, but for whatever reason, they don't close within 180 days. You failed to complete that. Boom, you pay your tax just as if it never happened. So you've got to complete these steps. You've got to hire someone to do the 1031 exchange, sell your property, tax deferred, identify 2 properties within 45 days, and then close within 180. And the money never touches your hands. It stays in the escrow account, and then it gets used towards a future purchase. But in most cases, you have to spend more money, not less, on the property or perhaps properties. And this is where you want to contact a 1031 exchange company and ask a lot of questions and make sure they're answering in such a way that you completely understand this. Now, if you sold a property at $250, everything I've been told is you have to spend at least $251 or more than $250. So I guess $250 and a buck or something, but it's more than you're exchanging for. So that can make a change for some people. So if you sold at $250 and you had $230 in cash, you'd contact your 1031 exchange advisor, but you need to spend more money on the next property to defer it and continue to build that. So you may need to contribute some money, or you may potentially get a small loan or something, but that's to be worked out. I'm sure there's other combinations, right down to owner holding a balance for the rest of the money due. That probably is a possibility. But here's where we've gone so far. We've talked about short-term capital gains, which is just your ordinary income, taxable like the rest of your stuff. Long-term capital gains, that's a year and a day or longer, 15% tax-deferred exchange, 1031 exchange. You just pay the tax at some point in the future when you want to start cashing things out. Now, why would someone choose to just pay the tax? Well, if they have an immediate need for the money and something that's not a like kind of exchange, so if you had a commercial property, you'd exchange it for commercial. If it was a rental property, you'd exchange it for a rental. If it was a duplex, and so on. There are times where it makes sense to cash the money out. And here's what I mean. Let's say you made $30,000 and you got to pay $9,000 in tax, short term, just by the example. That $21,000 in your pocket today could very well get you in a different type of investment. Maybe you want to buy crypto or stocks or bonds or a car or a wedding or the vacation of a lifetime. You might be willing to pay the tax because you're going to have to pay it at some point. It might be worth it to pay it now if what you're going to spend the money on has the ability to get exponential returns beyond what you get in the real estate place, or you've got a pressing need in your life for some of that money. And I'm giving you all the good stuff. And vacations. Wow, how about that? Fancy car, jewelry, travel, something like that. But it also could be a life circumstance where maybe you've had an unfortunate situation. And it could be it could be happy for a wedding, bad for a divorce. It could be a change in circumstance. You could be getting married. You could be getting divorced. Again, these things happen. It could be a job transfer. You might need money to relocate to a different place. I would let you just imagine what could go right or wrong where you'd be willing to pay the tax to get your hands on the money. And if you think people don't do that, look at all those lottery winners, when it's $2 million, but they cash it in and take $700,000 or $800,000 to get the money now, as opposed to waiting 20 or 30 years to get the million or $2 million. So there's always a reason that people will take less money to get the big chunk of the money right now and forgo the top side. And there's always somebody on the other side of it be more than willing to buy that asset off you and let it mature over time for the guaranteed return. So it works in both directions. As far as doing a 1031 exchange for someone that's going to continue to accumulate property as a lifelong strategy, it makes a lot of sense to keep rolling it back in, and people do this all the time. I would just say consult. Talk to your CPA, talk to your attorney, talk to a 1031 exchange company, and find out what's the exact right thing for you to do when you're selling your investment property so you can get the biggest bang for your buck, the best return, and make sure that it follows along your life path for investing and wealth building. And I think you'll be on the right track. That's a little bit about 1031 exchange today. Do not forget to subscribe. Go ahead and like us, leave us some comments. We look forward to seeing you on the next episode. This is Ron Wysokarski for the Black Hole of Real Estate.